Hello guys! Today I have a very special video for you. In this episode I will show you how to calculate the intrinsic value of a company. In this case we will use Meta as an example. I will show you how to calculate the fair value, what price should you pay for a company, what assumptions of growth, PE, margins should you use on your discounted cash flow analysis, how to do a discounted cash flow analysis, and how to be conservative on your analysis. So let's go into it. First, meta platforms. Why valuation matters? Everyone wants to find the intrinsic value, the fair value of a company. So you always want to find what's the worth of a company, so you can pay less of the company's worth. For example, if you use other example of clothes or any other item, you always want to pay less than it's worth. Here in the stock market, it's the same. You always want to pay less of the company's worth. So sometimes you want to pay 80% of their value, 60% of their value. It will depend on the company, on the quality of the company, but sometimes it's really difficult. So you always want to pay less of the intrinsic value so you can have a better return on the future. So the less you pay, the better returns in the future you will have. So what is the intrinsic value of any company? Intrinsic value, it's the theoretical value of a company's worth based on their fundamentals, their earnings, their cash flow, their growth in the future. So you have to assume a lot of things. It will be a theoretical calculation. You have to assume some growth, some margins, some revenue growth, a lot of things, but I will show you next. But Benjamin Graham said the company's worth, or the intrinsic value, is the sum of the cash flows that company will have in the future. So it's kind of that. So my preferred method to calculate the intrinsic value is discounted cash flow. There are other metrics, other ways to find the intrinsic value. Some investors like to look into the PE. There are the DDM dividend discount models, Graham's number. There are a lot of ways to calculate value of a company. In this case, discounted cash flow, it's good to analyze a company that is still growing, that is profitable, and since most of the companies I look into it are companies already mature or still growing, but they have positive earnings, this is the best method to use to analyze and to find the intrinsic value of a company. So this method doesn't work with banks, for example. That's really complex. I don't like to invest in banks. I have some, but when I look into banks, I like to look into their price to books, for example. But let's go. How do you calculate the intrinsic value? Here, looking into Meta, I like to have my Excel sheet with all the metrics they have, or compound or manage on the checklist. That's things I really like to see in a company to find out their quality and their moat. I like to look into their revenue in the last 5, 6, 7 years, their net income, for example. I use that. In this case, I will use a net income to find out the earnings in the future. I should use cash flows, for example, but in the future, net income margins and free cash flow margins should look the same when the company matures. So it's indifferent what kind of metric you will use. But first, a discounted cash flow. What is a discounted cash flow? A discounted cash flow is, you will assume the earnings in the next 10 years. For example, I will use a discounted cash flow for the next 10 years. First, I will look into the revenue this year. I will have a base case, a bull case, and a bear case in my model. So I will put the revenues here, and I will assume a compound growth rate for the next 10 years. Most investors use only one. I like to use a compound growth rate for the next 5 years and a different one for the 5th to the 10th year. And why I use that? It's because it's really difficult to a company to grow 10% in in the next 10 years. So when I look to Meta, they are growing around 37%, 26, 21, 37%, a negative 1% in the last year. And Meta is a really big company, and in the future it will be difficult to grow a lot as the company matures and grows bigger. So that's why I like to use a growth rate for the next 5 years and a different one for the last 5 years. So Meta, in this case, they are growing a lot, but I want to be conservative. So analysts are expecting the company to grow around 12% for the next 2 years. So I will assume this growth 12% for the next 2 years and 10% for the rest of the 5 years, and 6% for the last 5 years. So in 10 years, the revenue will grow from 131 billion to 288 billions. So what P should I assume? I will talk only about my base case. I like to do a bull case and a bear case. When I assume the most optimistic case and the least optimistic case, in that will be my bear case. I will assume a better growth rate and a lower growth rate. When we talk about margins, you always want to be conservative on your analysis. For example, their net margin for Meta stock has been 45%, 39%, 34%, 33%, and in the last year it was 20%. I don't believe it. Meta margins will be around 20%. I do believe they will be around 30%. If they were not investing a lot in this Meta investment, their margin will be really high. It will be around 35 or 40%. But since they are investing a lot, I will assume lower margin. So for my base case, I will assume 30%. For my bull case, 34%, and for my bear case, 26%. So what P should you assume? The mean for the market has been around 15. So you want to assume a higher P if it's a quality company growing a lot, and you will assume a lower P if you have a company that has not good quality. Their earnings in the future will be in doubt. For example, they are not growing a lot. For this case, Meta is still growing. It's a really good company, high quality with a wide moat. So I do believe we should assume a higher P. I will assume 18 and 20p for my bull case and 16 if they grow with this compound annual growth rate. I will accept if you use a higher P or a lower P. It's about preference. I'm trying to be conservative, so I will assume an 18p for my base case and 20p for my bull case and 16p for my bear case. I do believe they are one of the high quality companies out there, and if you want to assume a 22p, it will be fine. I do believe in the future they have a high return on invested capital, around 18%, so you can use a higher P in my opinion. So in the last thing, you have a discount rate. What is a discount rate? It's basically the return you want to have in this investment. The mean for the stock market is around 10%, and most investors use 10%. If you want to invest in the stock, specifically in a company, you want to have better returns than the stock market. So if you are expecting an 8% or 6% return from this investment, if you better invest in the market overall. So for me, when you talk about intrinsic value, the discount rate should be around 10%. That's the intrinsic value. But for me, I like to find the fair value for this company. I want to have better returns than the stock market. For my base case, I always go with 12%. For example, sometimes I'll go higher. For example, in Chinese stocks, I will go with a 15 discount rate because there are a lot of risk in this investment. But for Meta, really high quality company, US company, I do believe you should go with 10. I will go with 12% because I always want to find companies that I can have better returns than the market overall. So that's the discount rate I choose. You can go with 10. I will go with 12%. For my bull case, I will go with 14% because it will be difficult for Meta to achieve this growth rate of 12% and 8% revenue growth and 24% margin. So if they achieve that, I want a better return. And for my bear case, it's really easy for Meta to grow at this rate, in my opinion. So I want a lower discount rate. Basically, discount rate will be the risk. You have to evaluate the risk you have in this investment, and if you have higher risk, you should use a higher discount rate. If it's a really low risk company, you can assume a lower discount rate. So when I look into it, it's basically compounding the revenue into the next 10 years, assuming margins, net margin, cash flow margins, and you have the earnings in the 10th year. Basically, you have shares outstanding that you can assume the earnings per share. With the earnings per share, you can multiply for the PE you will assume, and you have a terminal value. So for my base case, the terminal value in 10 years, using a 10% and 6% annual growth rate with 30% margins, assuming a PE of 18, the value I found out for Meta, it's $856 for the investment in 10 years. So discounting that at a rate of 12%, the intrinsic value or fair value at this moment at 2023 here, it will be around $238. I mean $238. So at the moment the stock is trading at 300, so it will be slightly overvalued. I like to assume these three cases. I will attribute percentage of probability. In some case we'll have a higher probability of my base case and bull case, and since the risk is lower, I can attribute different probability, but it will be around that. You can change that. It's something I like to share. I will assume the net debt at the moment. Meta has more cash in hands than their long-term debt, so I will assume that cash they have in hand, they have around their net debt is negative, so they have no debt and they have cash in hand. They will have around $15 per share of more. So for my fair value for this company, for Meta company, will be around 256. So that's my fair value. It's not an intrinsic value because I didn't use a 10% discount rate. This is basically my method. I like to have my Excel sheet look into all the metrics Meta has, so I can have a better assumptions for my discount cash flow analysis. Of course, valuation, it's really important, but it's not only you want to have quality companies like Meta. I develop a quality score for my companies using my money journey checklist. Basically, it will evaluate all these points in the checklist and attribute a quality score. Meta is one of the highest, 88 of quality scores. Of course, the quality of the company interfere with the assumptions I have in my valuations. So, but in general, it is a really good quality. It will be really difficult to have Meta trading under their fair value again. It was a really good opportunity. At the moment, it's a null, but this is my method. That's how I calculate the intrinsic value of a company. So I hope you find this video useful at this moment, because it's really important to understand how to calculate and how do you find the intrinsic value or your fair value of a company, so you can know how to buy. You always want to buy companies trading under their fair value, but for quality companies it's really difficult to find that because for most of the highest or the better companies in the market, it's really difficult to find that at the fair value actually. So you slightly have to overpay assuming a higher PE, but that's my analysis, how my assumptions work. I always try to be conservative in my investments so I can have a better and a higher margin of safety. Basically, your margin of safety will be around their discount rate. So that's my process, guys. I hope you find it useful. I hope you liked, and then if you liked it, please subscribe. Bye, guys.